Hey guys, here is an example of applying market structure concept of smart money trading on the chart. And as you can clearly see, the market structure is to the upside. Since we have our highs and lows, we can clearly see that the market is to the upside. A graph of liquidity below these lows indicate what an upward continuation to the upside. When we are talking about market structure, we're talking about the skeleton of the price movement. We select the recent movement and try to determine whether we are going to buy or sell. The market structure will show us whether the market is trending to the upside or to the downside, or not trending at all in a specific time frame. Note, every price movement creates a structural level, and analyzing them knows which particular phase of the market we are in. So today's video is going to be an advanced tutorial about the concept of market structure in smart money trading. In this video, we'll cover the fundamentals of bullish and bearish structures and explore breakout, trend reversals, and liquidity concepts. So guys, if this is what you are interested in, hit the like button to help us make more videos like this and subscribe to our channel. So see you guys right after the intro. Now, what is the market structure exactly? Market structure refers to swing highs, swing lows, supply and demand areas, order flows, and the overall market condition. We have two market conditions, trending and ranging markets. In an uptrend, as the name suggests, the market moves towards the upside, creating higher highs and higher lows. Here, as you can see, an ideal ascending structure. The ideal means the market respects the lows and continue to move upward. In the uptrend, the market has a greater tendency to break the highs to the upside, although the market might not always move this clearly in the general definition that is commonly seen in the market. If you look at the 5-minute chart, you'll see that the upward movement is created by making higher highs and higher lows. So long as the market continues to break the structure to the upside, we have an uptrend. Now that we have talked about breaks, let's look at what breaking really means and what conditions to consider before a break of structure. Now, how does a breakout occur? A breakout occurs when a candle clearly breaks the previous market structure with the body. This means that the price can close a visible amount of pips above the previous high. Then we will have a break of market structure. Here is an important question. How can we ensure that the breakout is valid and not just a liquidity grab? In the case of a fake out or liquidity sweep, price immediately gets back into the range. So making our concept more advanced, if price wicks above the previous market structure, then closes back inside the range, we won't have a valid breakout, which is previously discussed. But in order to have a valid breakout, the following candle needs to close above the previous one. This is a strong sign that sellers have failed to push the price back inside, and buyers are in control of the market. Now guys, let's move on to the next topic, major and minor highs and lows. Now the question is, when is a swing high or swing low considered strong, and when is it considered weak? In an uptrend, strong lows are areas where this break of structure movement originates. So this is the highest point that the price has recently reached. If this low can break the structural levels to the upside, it becomes what? A major swing low. Otherwise, if it fails to create new higher highs and price pushes lower, we consider it a minor swing low. Now the question is, does a break above this high make the point become a major swing low? Well, the answer is no. According to the definition of a major low, we only consider a break above the highest point the price has recently reached. So after this break of structure occurs, this low becomes a strong or major low. As long as the low stays above this level, we are still in an uptrend. These points, when they are formed, are referred to as origin points, the point that the source of impulsive movement in the uptrend. To identify reversals, we examine the origin, and breaking below the last origin is sufficient. Use the same concept applied to a bearish scenario in a downtrend. Strong highs are areas where the break of structural movement originates, the point that were with the source of impulsive movement to the downside. Breaking above the recent origin point signals a shift in market momentum. Now let's move to the next topic, trend reversals. Before we do that, guys, make sure you hit the like button, subscribe to enable us make more videos like this. The structure of this market is to the upside because we have our highs, and lows, highs and lows, highs and lows. All right. So with that in mind, below the low, we have a lot of liquidity. All right. So when the market grabs the liquidity below, it gives it momentum to keep pushing to the upside. And if the market grabs the liquidity above, that means we should be ready for what? A change of trend. So like we can see in this case, we have what? A liquidity grab above. So we have a liquidity grab above. So and the market could not just keep going to the upside. And then here we have a break below the structure. Okay, we have a break below the structure and the market traded back to our fair value gap. So I'll be showing you guys this trade, how I took it on my live account. I'll just show you guys the exact same trade. So I had to like place my orders here. After the market came back to my fair value gap, my stop losses were just slightly above there. And then I went straight for my 1:5 weeks to reward. About, yeah. So let's look at this. See how beautiful this is. So it just went, price delivered. So it was 1:4. Yeah, remember that clearly. So price actually delivered very well. Just that. So guys, here's another example of a trade which I took. Okay, I'm just gonna break it down for you guys so that you can clearly understand. So now let's look at the higher time frame perspective. Let's start our analysis from there. Let's start the chart breakout down from there, so that you can all follow, you can all understand the reason why I actually took this trade. So I want us to go to the higher time frame, which is the 1 hour. So we are there already. Let's just look at a few things here. All right. So we had a break of market structure, all right, above. And what led to that break is this, our demand zone here, which I just marked out. Okay, so we just had our demand zone there, and we had that break of market structure, which is just right here. All right, so the market broke to the upside and then created a new high and created further highs and came back to our demand zone area. Okay, so let me just mark them out. Let me just take my time in marking them out. All right, so that's the number one area there, which we had a break of market structure, and also we had another break of market structure here, but the movement here, the retracement here wasn't much, and then the movement to the upside wasn't much. So that was why the possibility of it coming back to our demand zone was greater. All right, so patience is the key when it comes to this game. So patience is the key. You just have to learn to wait. Okay, so we had previously here a low, which there has to be what a liquidity would grab before the market can actually keep pushing to the upside. Okay, remember I said a gap in liquidity indicates further signs of the market moving to the upside. So now we are going to go down to the 15 minutes time frame so that we go to look at everything together. Okay, so we're going to zoom in a little bit, guys, and then we're going to mark our structures so that we can wait for a shift or a change of character. Okay, so a change of character indicates what a shift in market perspective. Okay, so that we can begin to look for longs. Okay, so right now we are on the 5 minutes time frame. We are waiting for the liquidity grab. So and that what actually happened, we have a shift of market structure. Then we had a liquidity grab. That's on the 5 minutes time frame. Okay, let me just mark that out. We have our liquidity grab, guys. We have the liquidity grab right there. So we go down to the smaller time frame. It can be the 3 minutes, the 1 minute, but in this particular case, I think I prefer the 1 minute because it gives me what clarity, guys. It gave me clarity. So you want to be dealing with something that you have a better understanding of, rather than just basing your assumptions and just doing something you don't understand. So guys, let me just go down to the 1 minute. Let me just go down to that area on the 1 minute, so that let me just show you the reasons why I actually took that trade on the 1 minute time frame. So on the 1 minute time frame, let me just zoom in a little bit so it's going to look clearer, guys. So reasons why we took that trade on the 1 minute time frame was because after the liquidity grab, after the liquidity grab, the market was supposed to come back to our fair value gap. All right, the market was supposed to come back to our fair value gap, and then I think we missed it. Yeah, the market did not actually do that, so we did not take this trade, guys. The market was supposed to come back to our fair value gap here, but it didn't, so we did not take the trade. But I think yes, there was another opportunity. There was another opportunity which presented itself, and we did take that one. So market was supposed to come back to that area, so that was where we were supposed to execute our trades, right? So we had our pending orders, but they weren't triggered. So here again we have another opportunity. Let's get back to the higher time frame, the 15 minutes, so that we can actually redefine the whole stuff for you guys to understand. Please, if you are new to my channel, don't forget to hit the like button, subscribe to this YouTube channel, so that it will encourage us to continue to make more and more wonderful videos like this. All right, so hit that like button. Also follow us on the Telegram channel, so that we can continue to grow and provide wonderful content for you guys. So remember, we missed that one. All right, so we have, but that's not the end of it, guys. So we have a demand zone here which was being created by the market. Okay, so let me just zoom in a little bit. So we have that demand zone, and then we have a break of structure to the upside, and then the market came back again to that area, guys. And then I think there was a liquidity grab. So there was a liquidity grab of the candle low, the previous low. There was a liquidity grab of that previous low before actually moving to the upside. So right now we're just going to scale down a little bit. We're just going to scale down the time frame a little bit, all right, so that we can actually understand what happened there. All right, so just going to understand that. So let's zoom in a little bit. Let's go back in time. Okay, here I think we have what we are looking for, guys. We have what we are looking for. All right, so here on the 1 minute time frame, you see that liquidity grab. Okay, on the 3 minutes time frame, we have that liquidity grab, and we have a change of character, shift in market structure. So right now, let's go down to the 1 minute time frame. All right, let's go down to the 1 minute time frame and execute our trades, guys, like legends, like kings, guys. So right here, we have what after the liquidity grab, we wait for a shift, right, which we have on the 1 minute. Right, we have a shift on the 1 minute time frame. Okay, we have our fair value gap, which the market came back into, and then we traded. We took our buys. We have that area. Okay, so we're just gonna mark it out, guys. Just gonna mark it out, and then we executed our trades. A stop loss just slightly below that low, guys. The stop loss just slightly below that area, guys. And we're targeting for like a 1:4, the next highs, the previous highs. Okay, all right, so we went for like a 1:4, if I could clearly remember. So let's go back to the higher time frame perspective. So, and that was super awesome, and the trade didn't waste our time, guys. So we went high and even went further. All right, so that was how I took this particular trade on the US 30. Right, so that was that. All right, that was that, guys. I think we're just gonna mark another area here where we had another entry. I think, yeah, we had another entry here. So we had a break of structure to the upside, and then I think the market returned back to our demand zone, and then from here we executed without wasting time, because I think that was around the New York session. There was volatility in the market as around that time. We have our fair value gap there, we have our demand zone, so every criterion for this trade was actually met. And see, on the 3 minutes time frame, there was every reason to actually take this trade. Okay, the whole thing played out nicely. You know, we just place our trades, stop loss just slightly below, and we went for our 1:4 at down this time, and the targets were actually smashed, guys. Target was smashed, guys. Target was smashed. So I just want to show you how it looks on the 1 minute time frame, so that you guys can see. Right, but still yet we took our trades. Targets were actually what smashed, guys. So guys, if you like what I do, please endeavor to follow us on the Telegram channel, hit the like button, subscribe. Also, that will encourage us to continue to make more and more wonderful videos like this. So other than that, guys, I just say you stay blessed, continue to learn, continue to advance yourself, guys. So see you guys in my next video.